So recently we saw a lot of people jump back into so-called risk assets, commodities, gold, stocks, that sort of thing. And at least as it relates to gold and commodities, people getting back in on this belief that Fed actions, quantitative easing, creates inflation or inflationary pressures, when in fact it doesn't. And simply to understand this is that the Fed, when it conducts these activities, basically all it's doing is just changing the composition of the financial assets that the public holds. If the Fed buys bonds to bring down interest rates at along some area of the yield curve, or just to expand its balance sheet, all it's doing is removing bonds from the public, replacing it with a cash balance. Bonds and cash are essentially the exact same things. They are both dollar-denominated liabilities of the federal government, and they're both dollar-denominated assets of the non-government or the public. So when the Fed buys the bonds, it's simply exchanging one asset for another. There's been no new net creation of financial assets, as we say. Now, when the government spends money, in the case of, let's say, giving a check for Social Security or paying a defense contractor, that is a net increase in financial assets for the non-government or the public. If you receive a Social Security check, you deposit that check, that's your money to keep. It doesn't come with a corresponding liability. However, when the Fed conducts QE, as I've just mentioned, all it's doing is really changing the composition of the financial assets held by the public, and probably changing the duration of those assets. What do I mean by that? Well, a treasury bond or a treasury note has some duration. It could be 2-year, 5-year, 10-year, 30-year. Cash has zero duration. So basically it's shifting it from a longer duration, shifting those financial assets to a shorter duration. That's all that's happening. There's been no net new creation of financial assets. So it's not inflationary. It's certainly not hyperinflationary. And that's why when you see these portfolio shifts driven by people who believe that those Fed actions are inflationary, once those portfolio shifts run their course, what happens? These markets come down. And that's exactly what's going to happen to gold and at commodities. Stocks, I would say there's also an element of some growth there in the economy that stocks are reacting to. But the whole concept or notion that this is inflationary because of what the Fed does, it's just absolutely not true. That's it for now. See you here next time. This is Mike Norman saying bye-bye.